Harvard University is embroiled in a significant financial and legal battle with the Trump administration, which has frozen $2.2 billion in grants and $60 million in contracts. This move comes after Harvard refused to comply with federal demands to audit students and faculty for viewpoint diversity. The administration has further escalated the confrontation by suggesting the IRS revoke Harvard's tax-exempt status, a move that could have severe financial implications for the university, potentially costing it over $465 million annually. Such a revocation would not only impact Harvard's ability to generate tax-free income and attract donor contributions, but could also set a precedent affecting the broader higher education landscape in the U.S. Despite its substantial $52 billion endowment, Harvard faces constraints in using these funds to cover the financial shortfall, as the endowment comprises numerous donor-restricted funds earmarked for specific purposes. The endowment's allocation strategy, heavily invested in private equity and hedge funds, reflects a long-term investment approach rather than a liquid reserve. The university's robust financial foundation, however, positions it better than most institutions to endure a protracted legal struggle. This conflict underscores the complexities of managing large endowments and the potential vulnerabilities even the wealthiest institutions face when confronted with unprecedented governmental actions.
Former President Donald Trump has publicly expressed his dissatisfaction with Federal Reserve Chair Jerome Powell, hinting at the possibility of his removal due to the Fed's decision not to implement aggressive interest rate cuts. This stance comes amidst ongoing trade tensions and tariff implementations, which Trump believes necessitate lower interest rates. The situation highlights the tension between the White House and the Federal Reserve, an independent entity responsible for setting U.S. monetary policy. The potential dismissal of Powell could have significant implications for financial markets, as it would suggest increased political influence over the Fed's operations, potentially unsettling investors who rely on its independence for stable economic policy. The uncertainty surrounding the Fed's leadership could lead to increased market volatility as investors react to potential shifts in monetary policy direction. This development is further complicated by broader concerns about the impact of tariffs on global trade and economic growth. Despite Trump's public pressure, the Federal Reserve maintains its independence, a principle crucial for ensuring decisions are based on economic indicators rather than political influence. Historical parallels, such as former President Nixon's attempts to sway the Fed in the 1970s, underscore the long-standing nature of political efforts to influence monetary policy. Under Powell's leadership, the Fed has focused on its dual mandate of stable prices and maximum employment, resisting political pressures to maintain market stability and investor confidence.
In a significant legal development, a U.S. judge has ruled against Alphabet's Google in a major antitrust case, marking the second such defeat for the tech giant within a year. The case, brought forward by the Department of Justice, DOJ, alleged that Google illegally monopolized the online advertising market. Jonathan Kanter, former chief of the DOJ's Antitrust Division, discussed the potential ramifications of this decision in an interview with CNBC. Kanter highlighted that the remedies would be forward-looking, focusing on current and future market conditions, particularly in light of advancements like artificial intelligence (AI) in advertising. This ruling could lead to more opportunities for businesses to monetize AI through advertising channels beyond Google's ecosystem. The court's decision is poised to reshape the advertising landscape, which has been heavily influenced by Google's dominant position. Kanter emphasized that Google's practices have overcharged and underpaid content providers, such as news publishers, thereby stifling competition. Google, however, plans to appeal parts of the ruling, maintaining that its tools are beneficial and chosen by publishers for their effectiveness and affordability. The outcome of this legal battle could potentially open the market to increased competition, fostering innovation and providing diverse opportunities for new and existing players in the advertising industry. As regulatory scrutiny intensifies, This case underscores the broader push for antitrust enforcement in the tech sector, aiming to ensure fair competition and prevent monopolistic practices.
Hertz Global Holdings Inc. (HTZ) shares surged by over 40% on Thursday, continuing a significant rally that began with a 56% increase on Wednesday. This dramatic rise in stock price follows the disclosure that Bill Ackman's Pershing Square Capital Management has acquired a substantial stake in the rental car company. Initially reported as a 4.1% stake, further information, revealed by CNBC, suggests that Pershing Square's stake is actually 19.8%, positioning the firm as the second-largest shareholder. The confidential treatment provision granted by the U.S. Securities and Exchange Commission allowed Pershing Square to accumulate additional shares beyond the typical reporting period. Hertz, which filed for Chapter 11 bankruptcy protection during the COVID-19 pandemic and emerged in 2021, has been focusing on a strategic pivot towards electric vehicles. However, the company has faced challenges due to declining vehicle values. Pershing Square's investment indicates confidence in a potential turnaround under new management, with a strategy that may include leveraging tariff advantages on used cars. The market's reaction has been overwhelmingly positive, with Hertz becoming a trending topic across various financial social media platforms, reflecting heightened investor interest and optimism about the company's future prospects.
In a significant development in global trade dynamics, former U.S. President Donald Trump announced the potential for a very good trade deal with China amidst ongoing tariff disputes. The U.S. and China have been embroiled in a trade war, with the U.S. imposing a 245% tariff on some Chinese goods and China retaliating with a 125% tariff on U.S. imports. While Trump expressed optimism about negotiations with China, no formal talks have yet been initiated. The Chinese government, led by President Xi Jinping, has been rallying support from Southeast Asian nations against what it describes as U.S. hegemonism and protectionism. Meanwhile, other Asian countries such as Japan, Vietnam, and Taiwan are actively engaging in negotiations with the U.S. to mitigate the impact of Trump's tariff regime. Japan, heavily reliant on the U.S. market for its automobile exports, is facing additional tariffs and is keen to reach a compromise. Vietnam, which has a significant trade surplus with the U.S., is seeking to increase its imports of American goods to avoid heightened tariffs. Taiwan, a major exporter of tech products to the U.S., is also in discussions to protect its interests, especially given the strategic security ties it shares with Washington. These developments highlight the intricate balance of diplomacy and economic strategy as countries navigate the complexities of international trade under the looming threat of increased tariffs.
Novo Nordisk's stock has been downgraded by BMO Capital Markets analyst Evan David Sigerman from outperform to market perform, with a significant reduction in the price target from $105 to $64. This adjustment reflects concerns over Novo Nordisk's competitive position in the cardiometabolic sector, particularly against Eli Lilly. Sigerman points out that Eli Lilly's drugs, Mounjaro and Zepbound, are rapidly gaining U.S. market share from Novo Nordisk's offerings Ozempic and Wegovy. The analyst emphasizes that while Novo Nordisk initially had an advantage with its semaglutide products, Eli Lilly's tirzepatide is now outperforming semaglutide in clinical comparisons, a trend that is evident in prescription data. The downgrade is further compounded by the lackluster results of Novo Nordisk's upcoming drug CagriSema from the REDEFINE trial and the looming threat of additional Eli Lilly drugs like orforglipron and retatrutide. These developments suggest increasing competitive pressure on Novo Nordisk, potentially affecting its market position and stock performance. As a result, Novo Nordisk's shares have dropped by 7.1%, trading at $58.41. This situation highlights the shifting dynamics in the cardiometabolic market, where Eli Lilly seems poised to strengthen its foothold, challenging Novo Nordisk's previous dominance.
United Health Group experienced its worst single-day drop in 25 years. significantly impacting Wall Street despite a broad rise in U.S. stocks. The S&P 500 managed a slight increase of 0.1%, with approximately 75% of its stocks climbing. However, the decline in United Health's shares tempered the index's overall performance. Meanwhile, the Nasdaq Composite saw a marginal decline of 0.1%, following a more substantial sell-off the previous day. United Health's significant drop in stock price is noteworthy given its influence as a major player in the healthcare sector and its substantial weight in major indices. The decline may reflect investor concerns over potential changes in healthcare policy or company-specific issues, which could have broader implications for market sentiment and investment strategies. The overall market's mixed performance suggests that while many stocks are gaining, significant downturns in major companies can offset broader positive trends. This scenario underscores the importance of monitoring sector-specific developments and their potential ripple effects across the broader market.
The core financial event in this news is the U.S. President Donald Trump's stance on tariffs, emphasizing his belief that tariffs are beneficial to the U.S. economy. During a meeting with Italian Premier Giorgia Meloni, Trump reiterated his position that tariffs are enriching the United States and expressed no urgency in finalizing trade deals, suggesting that other countries are more eager to negotiate due to their need for access to the U.S. market. Despite Meloni's efforts to sway Trump's stance, the meeting underscored the challenges faced by European leaders in negotiating with the Trump administration on trade issues. Key entities involved include the U.S. government, represented by President Trump, and the European Union, with Italy's Premier Meloni acting as a representative. The ongoing trade tensions have led to a temporary pause on some tariffs, such as the reduction of import taxes on the EU from 20% to 10% for 90 days. This pause highlights the volatility and uncertainty in global markets, as Trump's tariff policies have been linked to rising interest rates on U.S. debt and warnings from CEOs about potential economic repercussions, such as price increases and job losses. The broader context is the escalating trade war and its implications for the global economy. The U.S. administration's tariff strategy has been criticized for straining transatlantic relations and contributing to recession fears. Italy, which has a significant trade surplus with the U.S., is particularly concerned about the impact on its economy, with growth forecasts already downgraded. The situation underscores the complex dynamics of international trade negotiations and the potential for tariffs to disrupt established economic relationships, with significant implications for market sentiment and economic stability.
Microsoft is facing increased scrutiny from Wall Street as concerns grow over its artificial intelligence, AI investments, and Azure cloud growth ahead of its earnings report at the end of April. Analysts, including Jim Cramer, are questioning whether Microsoft is capitalizing on its early AI lead, especially after its partnership with OpenAI, known for ChatGPT, began to show signs of strain. Reports of Microsoft pulling back on AI-related capital expenditures, such as pausing data center projects, have fueled speculation about its long-term strategy. Despite Microsoft's commitment to spend $80 billion on AI infrastructure this year, analysts worry that any reduction in spending could hinder its competitive position in the AI space. The uncertainty surrounding Microsoft's strategy has led to a series of downgrades and price target cuts from major financial institutions. KeyBank downgraded Microsoft from an overweight buy, while Citi and Morgan Stanley lowered their price targets, citing concerns over Azure's growth potential. While Microsoft's stock has fared better than other tech giants in a challenging market, losing only 12% year-to-date, the looming economic uncertainties, including potential impacts from tariffs and a possible recession, add to the challenges. As Microsoft approaches its earnings release, investors are keenly awaiting updates on its AI expenditures and cloud growth to gauge its future trajectory.
Kraken, a leading cryptocurrency exchange, is undergoing a strategic reorganization aimed at streamlining its operations and expanding into traditional finance sectors. This move involves eliminating redundant roles, with layoffs estimated to be in the hundreds, as part of its preparation for a potential initial public offering, IPO, The reorganization is also aligned with Kraken's broader strategy to diversify its offerings beyond cryptocurrencies. A significant step in this direction is Kraken's recent $1.5 billion acquisition of the retail futures trading platform NinjaTrader, which aims to broaden its asset class offerings and attract a larger user base. Additionally, Kraken has launched commission-free trading for over 11,000 U.S.-listed stocks and ETFs, marking its entry into traditional financial markets. This strategic shift follows a favorable legal outcome for the company, with the U.S. Securities and Exchange Commission dismissing a civil lawsuit that accused Kraken of operating as an unregistered securities exchange. Kraken views this dismissal as a crucial victory, potentially removing barriers to innovation and investment in the cryptocurrency space. The changes occur in a regulatory environment that could become more favorable under President Donald Trump's administration, which has pledged more industry-friendly policies. These developments underscore Kraken's commitment to adapting and growing in a rapidly evolving financial landscape, potentially impacting market competition and investor interest across both crypto and traditional finance sectors.